Have you ever wondered how banks make so much money? When all you did was open a savings account or swipe your debit card, they advertise themselves as safe, helpful, and on your side. But behind the shiny logos and marble floors, banks are one of the most profitable industries in the world. And their profits come from you. Today, we're breaking down exactly how banks make money off your deposits, loans, and even your daily spending habits. And by the end, you'll see why your money might be working harder for them than it ever does for you. When you deposit money into your bank account, say $1,000, you probably think that money is sitting safely in a vault, waiting for you. But it's not. The second you deposit it, that $1,000 stops being your money in the bank's books. It becomes the bank's money. Legally, your deposit is a loan to the bank. They owe you $1,000, but they're allowed to use that money however they want, mainly to lend it out and make profit. This system is called fractional reserve banking. It's the foundation of how modern banking works. Here's how it goes. You deposit $1,000, the bank keeps maybe $100 in reserve, and lends out $900 to someone else. That borrower spends the $900, which gets deposited again into another bank, and the process repeats. That single $1,000 can turn into $9,000 or $10,000 worth of money circulating in the system. It's called the money multiplier effect, and it's how banks literally create money out of thin air. The most obvious way banks make money is through interest. They pay you a tiny interest rate for keeping money in your account, maybe 0.5% or less, and then they charge 5%, 10%, or even 20% interest to the people they lend it to. That difference is called the net interest margin. And it's where banks make billions. Let's simplify it. You deposit $1,000 and earn 0.5%. You make $5 a year. They lend your $1,000 to someone at 10%. They make $100 a year. The bank pockets the $95 difference. Now imagine that multiplied across millions of customers and trillions in deposits. That's how even local banks earn huge profits with almost no risk. If you think interest is how banks get rich, think again. The real gold mine? Fees. Banks charge fees for almost everything. Overdraft fees when you spend more than you have. Maintenance fees for keeping your account open. ATM fees if you dare to use another bank's machine. Wire transfer fees. Foreign transaction fees. Late payment fees. The list goes on. According to a recent report, U.S. banks made over $30 billion a year just from overdraft fees alone. That's not interest. That's just penalty money. Often charged to people who can least afford it. And the genius part? Most people never notice because it's small, consistent, and hidden deep in fine print. That's the art of modern banking. Make a little bit from everyone, quietly, forever. Loans are the beating heart of the banking business model. When banks lend you money, for a car, a home, or a credit card, they're not just giving you cash. They're creating new money that didn't exist before. Here's the trick. They don't lend you someone else's deposits. They create new money digitally and record it as a debt you owe them. So if you take out a $300,000 mortgage, that's $300,000 in new money injected into the economy, all backed by your promise to pay it back, plus interest. And if you don't, they take your house. It's a brilliant system, and it's perfectly legal. If there's one tool that made modern banks rich, it's the credit card. On the surface it's convenient, you buy now, pay later, but underneath, it's one of the most profitable products ever invented. Here's how banks make money from your credit card. Interest. If you don't pay your balance in full, you're hit with 20–30% interest. Fees. Annual fees, late fees, foreign transaction fees, merchant fees. Every time you swipe, the store pays around 2% to Visa, MasterCard, and the issuing bank. So whether you pay your bill or not, banks win. If you pay late, they earn interest. If you pay on time, they earn merchant fees. And that's why banks want you to spend. The more you swipe, the more they profit. Retail banking, your savings account, credit card and mortgage, is just one part of the system. The real profits come from investment banking, the high-stakes side of finance. Investment banks help companies raise money, go public, or merge with others. They charge massive fees, like sometimes millions per deal, just for structuring or advising. Then, they trade stocks, bonds, and currencies using their own capital, making money from market movements. The 2008 financial crisis exposed how risky this can be, when banks made billions on risky bets and lost even more when the system crashed. But when they failed, they got bailed out by governments. In other words, they keep the profits, and taxpayers cover the losses. That's not just smart, that's too big to fail economics. In the digital age, banks discovered a new way to profit: your data. Every transaction you make, where you shop, how much you spend, what you buy, creates a data footprint. Banks analyze this data to sell you new products, like loans or credit cards, predict your financial behavior, even sell aggregated data to marketers or credit agencies. You might not realize it, but your spending habits are worth millions in insights. It's not just money they manage anymore, it's information. And in the 21st century, data is more valuable than gold. Here's something most people never think about. Inflation helps banks. When new money is created through loans, the overall supply of money increases, meaning your savings lose value over time. You might earn 1% interest in your savings account, but if inflation is 4%, you're actually losing 3% in real value every year. Meanwhile, banks keep earning high interest rates on loans. They profit while your purchasing power quietly shrinks. Inflation is basically a silent tax on savers, and the banks are the ones collecting the benefits. Banks love to sell the image that they're your financial partner, helping you save, buy a home, or invest for your future. But let's look closer. When they help you buy a home, what they're really doing is earning decades of interest from your mortgage. When they help you build credit, they're training you to become a long-term, reliable debtor. Their goal isn't to make you rich, it's to keep you financially active. The more you borrow, the more you spend, and the more you transact, the more they make. The average person pays thousands of dollars in banking fees and interest every year, all while thinking their bank is free. It's not free, it's just cleverly packaged. Banks have three massive advantages that make their business nearly unbeatable. They control the money supply. Every dollar you use flows through them in some way. They use leverage. They can lend out money they don't actually have, multiplying profits. They're protected by governments. Even if they fail, they often get bailed out because the system can't function without them. It's a game that's nearly impossible to lose, for them. For everyone else, it's a system designed to keep you spending, borrowing, and saving just enough to stay in the cycle. Now that you know how banks make money off you, how can you flip the script? Here are a few practical ways. Use high-yield online banks. Earn 4 to 5% interest instead of 0.1%. Avoid debt traps. Pay credit cards in full every month. Invest your savings. Don't let inflation eat your cash. Understand fees. Read every account term and switch if you're being charged unnecessarily. Build assets, not liabilities. You can't destroy the system, but you can stop feeding it blindly. At its core, banking isn't about money, it's about trust. The entire system runs on one fragile belief, that your $1,000 will still be there tomorrow. If everyone withdrew their money at once, the entire system would collapse, because the money isn't really there. That's the paradox of banking. It's built on confidence, not cash. As long as people believe in the system, it works. And that's why banks spend billions to look strong, stable, and safe. Because the moment people stop believing, it all falls apart. So, how do banks make money from you? They lend your money. They charge you fees. They profit from your spending, your debt, your data, and even inflation. They make money when you save. They make money when you spend. They make money when you borrow. It's one of the most sophisticated business models ever created, and it's built entirely on your participation. But once you understand the game, you can start playing it differently. You can build wealth outside the bank, instead of being the fuel that keeps it running. Because the truth is, banks aren't evil. They're just really, really good at making money from your money. If you found this eye-opening, hit that like button and subscribe for more videos that uncover how money, business, and power really work. Comment below if you want me to cover how credit cards keep you in debt, or the hidden secrets of the Federal Reserve. And remember, the buwain dayan no mendei sa titans in kren of dan no an sound desendan shakvri no arjista shustat sad. Obabowarn's rule of money is simple. If you don't understand how something makes money, it's probably making money off you.